Hey guys, what's up? Alec back with the daily stock market, and look at that pretty red day that we had on Friday. Coinbase down 7%, many other stocks down around 5% as well. But in this video, what we're going to be talking about is the top 5 dividend stocks that everyone should have in their portfolio. If you're a dividend investor, then this video is going to be for you. Before we jump in the video, make sure you're subscribed on YouTube with post notifications on, and share this video with a friend if they're a dividend investor as well. And we're going to make this a quick video today because it is Saturday, so we're not going to go in huge detail. Just think of this as a bonus video. So first one up is an ETF, and it's VYM, ticker symbol, Vanguard High Dividend Yield. This is a staple ETF in most dividend investors' portfolio. Obviously, we want to see it closer to $95 per share and under $100 per share. But the best thing you can be doing with dividend investing is just dollar cost averaging in for the long term and investing for 5-10 years or even more. So if we scroll down, we can see that the top 10 holdings are ExxonMobil, Johnson & Johnson, JPM, Chevron, Procter & Gamble, Home Depot, Pfizer, and a few others. And that makes up about 25% of the basket. We can see the 30-day yield is 2.9 and the PE ratio is around 11, implying that this ETF could be a pretty good deal right now. Okay, the next one on the list is going to be Johnson & Johnson, another staple in every dividend investor's portfolio, up 6% in the past month. In the last year, it's up 7%. Outpacing the S&P 500 by a long shot. The S&P 500 is down around 17% on the year, and we have Johnson & Johnson up around 8% on the year. Now, the 5-year growth has only been 26%, so you can see you're not going to get extreme stock market growth from this stock, but if we scroll down, the good thing is it does have a chunky dividend yield around 2.49%. And the good thing is with Johnson & Johnson, there is a good chance you're not going to be losing money for the long term. There's a good chance you're going to be making money on the stock appreciation, the stock gain, but you're also going to be making more money on that dividend yield of 2.49%. Also have a PE ratio of 24, implying that's a fair deal right now, and a market cap of around $500 billion. Okay, this company, Johnson & Johnson, was founded in 1887, so it's been around for an extremely long time. And if I had to buy, had a price point for Johnson & Johnson, it's going to be $160 per share or under. Now, the next one up is Verizon. I think this is one of the best deals on this list at the current price of only $38 per share. So if we look what's going on with Verizon with stock, we can see it's down 12% in the past 3 months, and it's down 24% in the past year. It's outpacing the S&P 500. Remember, it's only down 17%. We have Verizon down 24%. So it could be a good buy the dip scenario on this dividend stock. Verizon obviously is going to be around for a very long time. T-Mobile, Verizon, and AT&T are pretty much the only phone carriers in all the United States, the 3 biggest ones. And to have a share of telecommunications is definitely good for your portfolio. But this is when it gets really attractive. Look at that dividend yield. We have a 6.6% dividend yield. So it's one of the largest dividend yields on this entire list at 6.6%. It's also one of the lowest PE ratios of 8.3%, implying that right now it's actually one of the best deals out of all these dividend stocks on this list. And we will be doing a video about stocks under $10 per share for one of our next videos. So make sure you're subscribed with post notifications on if you want to get alerted for when that video comes out. Best stocks under $10 per share. But we have Nintendo, which falls in that category. It's only $10.50 per share right now. It's also a big dividend stock. We see them up 5% in the past week. And in the past year, they're down 7.6%. So they're still outpacing S&P 500. They are a little bit more risky because they are an ADR stock, meaning that they are not based in America. But we can see that they are down around 35% from highs, implying that they could be a good bargain at the current price. However, if we scroll down, we can see that the PE ratio is 42, implying that, yes, it might be a little bit overvalued. And if we're able to buy closer to $7 or $8 per share, we can be getting a lot better of a deal. Headquarters are obviously in Japan. Dividend yield is 3.7, so it's a little bit higher than some of the other ones on this list. The market cap is only 55 billion, so they have a lot of room for growth. The good thing about Nintendo that people don't realize, yes, they own Mario, Mario Party, Super Smash, all that good stuff, but they also own Pokemon, Charizard, Pikachu, and a lot of other stuff that people don't think about. In my opinion, Pokemon are going to be around for the next 5 to 10 to 15 years. Super Mario, Princess Peach, all of those characters are going to be around for the next 5 to 10 years at least. So I believe in Nintendo for long term. Also, if we dive into the fundamentals on Nintendo, they also look pretty strong. So let's dive into that very quickly. So here we can see that they are a profitable company. They've been growing net income since 2018 to 2022 by a long shot. It was 140 billion on net income in 2018, raised all the way up to 477 billion in 2022, which is huge net income growth. If we look at the total revenue growth, we can also see that has grown tremendously in the last 5 years from 1 trillion to 1.7 trillion. But this is what I really like about Nintendo stock and why they are in my dividend portfolio personally, is they have one of the best balance sheets in all of the stock market. In the whole stock market. If you know fundamentals and you look at a lot of balance sheets, you'll be hard pressed to find a better balance sheet than this. With only 22% debt to asset ratio, Nintendo has a one of the lowest risks stocks for going bankrupt in the whole market. Okay, they have 2.6 trillion in assets and only 500 billion in liabilities. And if we jump in, see what's going on, we see cash and cash equivalents and short-term investments is 1.7 trillion. And cash and cash equivalents alone is 1.2 trillion. So they have more cash and cash equivalents than they even have on total liabilities. So if we scroll up here to total liabilities, we can see that they only have 590 in total liabilities, and just their cash and cash equivalents make up 1.2 trillion, which is outstanding balance sheet and outstanding for any company to see that on any balance sheet. So Nintendo gets an A+ on their balance sheet. They also have good revenue growth. They had a little hiccup on their most recent year. And if we look at their quarter over quarter, it isn't growing like it used to. So we want to keep an eye on that total revenue, but more importantly, we want to keep an eye on that total income and see that they can grow at least 10 to 20% on their net income and their total revenue year over year. If we look at the quarterly on net income, we can see that that is falling. It fell from Q3 2022, but it is balancing out now, and we just need to get that upward trajectory once again for Nintendo stock. And the last stock that we'll be talking about on this video is going to be Microsoft at $241 per share currently. We can see in the last year they're down 29%, so they're outpacing the S&P 500 by a long shot, implying that they could be a good deal right now. We can see Microsoft going closer to $225 per share to $205 per share. That's where I personally have price alerts at. Now, we will be doing a deeper dive video on this channel on Microsoft and why I think the prices can get that low. So make sure you're subscribed with post notifications on so you get alerted for that future upcoming video. You might not expect Microsoft to be a dividend stock. They have a $1.8 trillion market cap, a PE ratio of 25, which I think is very fair for a stock and a moat like Microsoft. The dividend yield is 1%. Okay, it's not the best dividend stock in the world, but the good thing about a stock like Microsoft is it's going to have a lot of gains and appreciation on the stock price. So yeah, you're only going to get 1% dividend per year from Microsoft, and they probably will continue to grow it a little bit higher to like 1.5%. But the main good thing about having Microsoft in your portfolio is the stock could appreciate at 15 to 20% gains per year over the next 5 to 10 years. So when you are dividend investing, one thing I want you guys to focus on is think of the dividend as a bonus and really dive into the company as a whole, and the stock price appreciation is more important, because if Microsoft appreciates at 20% per year and a different dividend stock that you jump into only appreciates at 2% per year, okay, but you get maybe 6% dividend yield from it, that's 8% total per year. But Microsoft, on the flip side, has a 1% dividend yield with a 20% gain on stock price year over year. That's a 21% gain on an asset like Microsoft. So don't just look at the dividend yield and say, oh, the stock with the highest dividend yield, that's the best stock for me. You have to find a balance between a good company, the stock price that's going to appreciate, and also a good paying dividend yield at the same time. So there's a balance. So I hope that dividend investing video did help you out. I wanted to make it a quick video with just my quick thoughts. We'll do more deep dives on the channel in the future, so make sure you like and subscribe. If you want to join my close friends list, I post what dividend stocks I'm buying every single day. I have an awesome dividend list of 20 of the best dividend stocks that I personally invest in. It's a dividend portfolio. I also do option trading. So here you can see, if you click success number 6 on my highlight, by the way, you can see awesome success that people have been having, up 3,000 this week just from options, 20% in a week. You can tell it's paying off. Go through some of these success stories, read them on your own, take 5 minutes, see what some of the students are saying from the program. We also do swing trades as well if you're not into options, and we also do long-term trading and long-term investing too. So it's a full stock market program to make you a more experienced investor no matter your trading style. So message me here on Instagram. I'll shoot you over an application and then my website so you can check out everything on your own and see if it's a good fit for you. Thank you guys for all the love and support. Share this video with a friend if you think that they will find it helpful. And I'll see you guys in the next video. Remember, don't time the market, buy the market. Peace.